Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me are Mike Blankenship and David Sakowitz, partners with the Transactions Department of Winston and Strawn, to discuss the volume of SPAC activity why a company would choose to go public through a business combination with a SPAC versus an IPO. It's great to have you both with us here on Trade Talks. And Mike, SPACs are getting a lot of attention in 2020 as companies look for alternative ways to go public. What is a SPAC?
Yeah, so a SPAC, or a Special Purpose Acquisition Company, is a company formed to go public with a small group of investors. Essentially, it's a pool of money that they raise to go out and seek acquisitions. Usually, always the money's put into trust, and once they go out, they usually have 18 to 24 months to seek an acquisition. So that's hence the name Special Purpose Acquisition Company.
That's right, Mike. And under the SEC's rules, SPACs are not allowed to have a particular acquisition target that they've already been negotiating with. So rather, what you're selling in a SPAC registration statement is really the expertise and the experience of the founders of the SPAC, who are typically, experienced business persons with successful operational or investment backgrounds, often in private equity, and often they also have significant experience in particular industries or market segments or geographic regions. And these will be the people who will be responsible for searching for and completing a business combination within the permitted time frame.
David, why would a company choose to go public through a business combination with a SPAC versus a traditional IPO?
That's an interesting question. We represent a lot of targets in addition to SPACs, and it used to be the case that going public through a business combination with a SPAC was the less desirable route because of the perception in the marketplace. I think that's no longer the case, and the SPAC route is now perceived as a really viable alternative to the IPO route in all circumstances. One reason is the speed of the transaction. A SPAC business combination generally is a little quicker. You can get to the capital markets in 3 to 4 months or so versus maybe 6 to 9 months with a regular way IPO. You also have greater pricing certainty in a SPAC business combination because you're negotiating value with a specific third party and not with the public markets at the time of the pricings. And as we all know, depending on the volatility of the markets can significantly undervalue a company depending on the timing of when you go to market. Another key consideration is the certainty of financing, because SPACs have the money, or at least a good portion of the money that they need in order to consummate the business combination in trust already. And then they can also raise additional cash through equity at the time of the business combination. Traditional IPOs traditionally price a little bit under market. That's why you get a first day pop for most IPOs, and that's money that could be the companies or belong to the existing shareholders that instead would go to the initial buyers. Shareholder liquidity is another key driver of these transactions. Traditional IPOs provide at most around 10% liquidity to shareholders, and de-SPACs have the flexibility to provide for a lot more. Another key consideration is how the deal can be marketed. Generally, in a proxy statement for a de-SPAC, you're allowed to use forward-looking projections, which is particularly good for high-growth target companies. That would not be permitted in a traditional SEC registration statement for an IPO. And finally, the SPAC sponsor group could be very helpful in either helping to manage or advise the existing target management team going forward. If the sponsor team has a lot of industry knowledge or experience or network that would be helpful going forward, then that's another thing that they bring to the table.
Mike, what trends are you seeing with SPAC IPOs? Are there specific sectors or business models that gravitate to SPACs? Yeah,
so the specific sectors, we see a lot of transportation, so you're seeing a lot of technology, life sciences, energy transition. Those are sort of the trends in the SPAC IPOs, and because of the type of private target they're seeking, a lot of the capital needed to acquire them, and what those a lot of those aren't willing to go public in the traditional model, as David was pointing out. The SPAC becomes something that attractive to them to be part of, to do the business combination with that SPAC. As far as trends, we are seeing some usually SPAC comes out with a share and then offers warrants to investors, be it a half warrant or a third warrant, depending on the founders and who they are. We are seeing a lot of repeat founders or sponsors doing one, Series SPAC 1, 2, 3, 4, because of the success they've had in the past. One of the most interesting dynamics is the innovation of this. I mean, people are changing the structures, which is good because it will continue to be a popular vehicle due to the innovation. So I think we'll continue to see that. One being trying to change, shifting from the type of investor base to whereas more hedge funds are that are investing to more long-term retail investors that will stay there post de-SPACing.
And David, with the amount of SPACs coming public in 2020, there is some scrutiny in the marketplace as to why, with all the volume, is there any legitimacy to that?
Well, I mean, the reasons for the volume are, the factors that that Mike and I have already discussed, and why SPAC IPOs and SPAC business combinations are, now a really legitimate alternative to the traditional IPO route. As I think a lot of your viewers will know, SEC Chairman Jay Clayton gave an interview a few days ago on CNBC where he was asked about SPACs. And to Chairman Clayton's credit, he did take a quite balanced approach, and he noted the fact that SPACs really do bring something new to the table, and that they provide healthy competition for the traditional IPO route. But he did make some statements indicating that the SEC might start scrutinizing SPAC disclosures a little further, particularly with respect to the arrangements among the founders and exactly what their interests in the sponsor entity are and what their incentives are. So, we don't know where that's going to lead, but I think that is something that is a bit opaque in the market right now. And so, if the SEC continues to believe that that investors need more information on those subjects, then we could see either rulemaking or just enhanced scrutiny of SPAC documents in the future. There's been a lot of bad press, in particular about the Nikola transaction recently, and so I would imagine that's causing a lot of the focus on SPAC disclosures currently. But in general, I think it's just an area to watch. I don't see the boom ending anytime soon, but I think as the SPAC market matures, SPAC disclosures will evolve, and SPACs also will find new ways to differentiate themselves in the market.
Mike, what are the benefits to a sponsor for forming a SPAC?
Yeah, I think the top one is efficiency, meaning that they can get that done in 3 to 4 months, as David indicated. It's a quicker process, it's minimal disclosures, and you have a pool of cash sitting, albeit in a trust. There is some certainty around for a target to know that you have that money to go out and purchase, and then you can use the equity of the SPAC in a PIPE transaction. So I think those are sort of a key things. Timing, efficiency, and having cash are key benefits to sponsors, and they're using their names to leverage deals, is also to source deals. Have whether it's direct independent directors or whether it's the management themselves. I mean, we see a lot of rock star investment managers out there forming, and we also have former politicians and others that are forming SPACs. I mean, it's really hot. Everyone's trying to get into it, and I think sponsors look at that as opposed to the traditional model of a PE or other sponsors going out using committed capital to buy something and having to do a capital call. Now you actually have that cash, and you can source the right deal.
David, where does Winston and Strawn fit into the SPAC ecosystem?
Well, thank you for asking. So we've always been on the forefront of new developments on both the capital markets and M&A fronts, and so even before the SPAC boom that we're in currently, we were heavily involved in the sector. So we do. We're one of the leaders, if not the leader, in SPAC IPOs and business combinations. We represent both issuers and underwriters and sponsor groups on the IPO front, and then in the de-SPACing front, we work regularly with both the SPACs and the targets on those transactions. We've recently been involved in some of the highest profile and most successful de-SPACing transactions out there in the market. The DraftKings transaction that closed earlier this year is a prime example of that one. We're also currently representing Skills in their de-SPAC combination with the Eagle Group, which is currently in the preliminary proxy statement stage with the SEC. And we've done a ton of other both IPOs and de-SPACs in fintech and other industries, including the energy industry. We at Winston have a highly collaborative SPAC group, both internally and externally. So we, I'm primarily a capital markets lawyer, but I work a lot with Mike and other members of both the capital markets and M&A teams to get all these deals done. And we currently have at least 6 IPO in process in-house that I know of, and many more business combinations coming down the pike. I would also note that in our SPAC practice, as the SPAC world generally has become increasingly international. So we're working not just with US sponsor groups, but also sponsor groups in the UK, such as for the Broadstone acquisition SPAC that we just closed a couple of weeks ago. We're currently working on a French SPAC that's organized in France and will be listed on Euronext in Paris. And we're also working increasingly with Asian sponsor groups out of Singapore and Hong Kong. So I would expect that trend to be continuing as well, both for us and the market generally.
All right, and that's a perfect place to wrap up. David, what's your outlook for SPACs going forward? It sounds like private companies continue to look for different ways to access the capital markets. Every other sector in the economy is looking for innovation, so why not going public?
I agree with you. Based on the current numbers, we think there's going to be around 200 SPACs looking for targets in the next year and a half. There's the new ETF for SPACs, and so I think the market will continue, but there will also be continued both innovation and maturation in the market. And I think increasingly SPACs will need to differentiate themselves not just by refining their investment strategies and the description of the founder groups that are in their SEC documents, but also potentially in structuring and with respect to the funding of the trust account and the structure of the warrant coverage and factors such as those.
And Mike, I'd like to hear your outlook as well. If you have the same expectations where private companies are going to continue to look for alternative forms of accessing the capital markets.
I do. I think I agree with David that the outlook looks positive for SPACs. There will be over 200 come next year. Right now, with the Fed keeping rates low, all that financing is sometimes difficult for folks to get financing here. We know that there's a pool of cash, and as David said, it's very innovative. One I'll plug real quick that we just announced, and it's on your exchange, is the Diginex, which is the cryptocurrency exchange listed. Completed that yesterday. David worked on that one. So we see a lot of that going forward, and I think the industries that we see coming out of the pandemic, healthcare, energy transition as ESG friendly companies, and so we're keeping our eye focused on that, and we have many clients and potential clients in that area, and I think it's going to continue to be a global thing, as David pointed out.
All right, David, Mike, thanks for joining us on Trade Talks.
Thank you.
Thanks so much.
You got it, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.